Okay, all right. Let's, then discuss banks and more with our next guest. Our market master of the day is Dhiraj Agarwal, Managing Director at Ambit Investment Managers. Dhiraj, great to have you with us. Hope you had a fantastic Diwali and greetings of the new somewhat to you and your team.
Thank you so much.
That's the real question, right? Like in the absence, the moment this India-US trade deal comes through, we'll have a different conversation. But as of today, in the absence of that clarity, I mean, are earnings giving enough ammunition to the bulls to sustain above all-time highs and to decisively head higher from where we are?
Not at this moment, no. But the hope that the next quarter earnings will be significantly better is high because the festival season demand has been pretty robust, triggered by festival season itself, obviously, and the GST cut impact flowing through. So I hope that the December quarter earnings are significantly better than what we have seen in the last few quarters. And that will be very, very essential, as you rightly said, to keep the market sustained at a much higher level.
So, Dhiraj, let's talk about financials, right? Because that's where the excitement really is, whether it's numbers, whether it's deals. It's all about financials now, finally. First, let's talk on just purely on P&L, what you've seen from large lenders so far, or even large NBFCs. Like most point out, the margin compression has been lower than anticipated. Now, Kotak could be an exception, and therefore Kotak's kind of lower today. But what is your read-through looking at Q2 earnings so far and the commentary?
I think if you see Q2 earnings so far, barring either a small margin beat or a small margin slip, which I think is too much of micro-analyzing, results have been by and large in line. So there are no big positive surprises, there are no big negative surprises. And once again, going forward, I would link financials to the strong festival demand that we have seen in the month of October. Indian financials are a lot more linked or leveraged now to consumer demand as compared to capex demand, right? Because everybody is growing the consumer book much faster than the industrial book or the corporate book. And hence, if the consumer uptake that we have seen in the last 1 month sustains, I think credit growth also picks up at least by 200 basis points. And that will be good news for financials too. So to sum it up, I am positively inclined towards financials.
What percentage of your portfolio will you allocate to financials, NBFCs, the capital marketplace?
Yes, NBFCs and financials for sure.
And what percentage of your portfolio?
Yes, I will be overweight, meaningfully overweight.
Meaningfully overweight. So if, banks account for what, 35% of the Nifty? Approximately 32%. So how high would you go?
That's a tricky one, but I personally am comfortable going up to 40, 42.
Oh, okay.
Yeah.
All right. Hi, Dhiraj. What about tech? How are you placed out there? You get the signals that are coming there, rather mixed. The next management as well, I request you to, tune into that conversation. We'll have Sudhir ji who will be talking about Coforge's numbers. And Coforge as well as Persistent have continued good growth. And that's why the street rewards them with good multiples. So how would you place yourself on tech, between the large cap, the smaller cap names, and what do you like?
So tech is a very, very bottom-up space at this point. So industry as a whole is struggling for growth. The industry as a whole, the growth is now at best mid-single digits, which doesn't make the outlook for the sector as a whole very exciting. Valuations haven't yet come down to, my benchmark is valuations have to come down to 2016-17 levels, and there's still another 20%, 25% low for the sector valuations to go to reach there. To say that even the current low growth is now fully discounted and one can now buy as a bargain buys. So tech is, you can't even differentiate tech into large, mid and small and bucketed saying mid and small is doing better than large. There are few individual names, as you rightly pointed out, which are continuously outperforming in the earnings, and markets are rewarding them with much higher multiples. But overall tech, I would continue to be cautious till such time valuations guess 2016-17 levels. That's my broad benchmark.
Okay, that's IT. Dhiraj, what else? What else are you studying, observing? Maybe don't have a straight-out buy as yet in this market. There are a lot of the new age plays as well, or plays that are quasi-linked to new technologies now, whether that's EV or whether that's data centers. Anything that catches your fancy?
So one clear space, we started the discussion with strong consumption demand, but we didn't discuss the consumption sector. So consumer discretionary with an element of premiumization, that is one clear space which I think should stand out. And again, I'm qualifying this slightly by saying one hopes that the December quarter numbers are strong and this momentum continues at least for a few quarters more. There is also an expectation that the 8th pay commission, once it comes into play next year, sometime mid of next year, will also help consumption. So, but more positive on discretionary as compared to staples. Staples has its own challenges, and a little bit of price cut doesn't really move the demand needle for staples, but it does move for discretionary.
But discretionary, Dhiraj, allow me to ask you, because discretionary itself is a very wide umbrella. So, it could include alcobev companies, it could include jewelry companies, and so on and so forth. So, if you could kind of give us some more clues and hints, what part of consumer discretionary looks good to you?
So, I classify even automobiles, the personal use automobiles, not commercial vehicles, as discretionary consumption. So, that would be my number one bet, because automobiles, the price elasticity, the demand elasticity to price is reasonably high. And I would be surprised if demand growth does not pick up and sustain for a prolonged period of time. Once you go below that, then it's very, very individual, stock specific. I think jewelry should do well generally as a basket, now that the gold price is trying to settle down at a slightly lower level as compared to the recent peak. Typical consumer behavior is when the gold price is rushing, they sort of hold back on jewelry purchases. When it cools off a little bit and settles down, the jewelry purchases come back. So jewelry could be another sector. Consumer durables, white goods, brown goods, those would. So the segments which are typically price sensitive, air conditioner prices goes down by 10%. You say, chalo le lete hain, bahut din se postpone kiya hai. Same thing for cars, etc. So higher ticket consumption and more premiumization consumption as compared to lower ticket. I think that should pretty much classify where my thinking is.
Dhiraj, any initial thoughts on Lenskart? There is a press conference scheduled today. We know it's a very popular brand across age categories. The company has grown very fast. As of FY25, the company's top line is 6,650 crore rupees. So it's grown fast. The only thing is, when you look at the valuations, I think it's going to come up, fairly steep. Trailing, it's more than 200 times. FY25 PE, I believe, is more than 200 times. Market cap will be 70,000 crore. Have you any initial thoughts on this? Not a buy or sell, but considering it's a consumer company and that's a space you're interested in.
So it's seeing a very, very strong growth, right? So typically, any company which has that kind of a growth, we always find markets struggling to figure out what the right pricing is. So I think it should get a good response. I think it should do a good listing as well. How far the listing gains actually sustain will depend upon can they sustainably deliver the growth in the next 2 or 3 years. But typically, very high growth companies tend to get rewarded with excessive valuations in the market. So I think Lenskart falls in that category. They've executed really well. So on the whole, on the IPO itself, I'm positively biased, but let's see long term.
All right, Dhiraj, quick word on renewable energy. I think that was the theme that you said has a bigger runway. How do you approach it? Because there are various verticals, whether you're going for solar, the different other types of energy, maybe another way of looking at it. So tell us more about this theme that you like, renewable energy.
So as a percentage of total energy consumption, renewables will keep going up. There is a clear government thrust, there is a clear need with respect to pollution, environment, and climate. And every company involved, including NTPC, which has historically been a thermal energy company, has been investing a lot in the renewable space. So the entire ecosystem within the renewable space, whether it is battery storage systems, panel makers, the energy companies itself, etc., will see a very strong business environment for the next 10 or 15 years. To convert that into stock picks is, however, a little bit more challenging. So, for example, if BESS takes off, the T&D investment required will be lesser than what we believe will happen at this point of time, so one needs to take cognizance of that. There are lots of new emerging technologies which can disrupt linear thinking that this will require more T&D, hence just go ahead and buy T&D companies at any valuations. And the third that one needs to take cognizance of is many of the companies which are leveraged to renewable energy space are already trading at pretty steep valuations. And one of my observations in the market at this point of time is markets have become valuation sensitive. We have seen quite a few stocks, despite good growth, but valuations being steeply high, actually not performing in this market.
Dhiraj, always a pleasure chatting with you. Thank you very much for joining in.